inflation is headed back up. And this should be a much bigger problem for the markets than it was. But the fact that we didn't really get a big sell-off in gold, gold is starting to hold up better now with hotter than expected inflation. Now, eventually, gold's going to go up and up big with worse than expected inflation. When the markets figure out that worse than expected inflation isn't bad for gold because it means the Fed is going to fight harder to beat inflation, it's good for gold because it means the Fed has already lost and is giving up the fight. Inflation won, and it's going to move higher and higher and higher.
The gold market is excited as prices soar to new heights, inching closer to a significant milestone of $2,100 per ounce, thus setting up a potentially game-changing week filled with substantial macroeconomic risks. The market is experiencing its most impressive weekly gains since November, achieving a record-high close and displaying over a 2% increase from the previous week. The surge began on Thursday as prices surpassed the initial resistance level of $2,050 an ounce following a Federal Reserve report indicating a mild increase in consumer prices. Peter Schiff, a prominent American stockbroker, is confident that gold will experience a substantial rise in value due to inflation rates exceeding expectations. He believes that if inflation worsens, the Federal Reserve will intensify its efforts to mitigate it, which is favorable for gold prices since it implies the Fed has essentially surrendered in its battle against inflation. However, some analysts caution that gold could face a critical test next week with the release of February's non-farm payrolls report and Federal Reserve Chair Jerome Powell's testimony before Congress. These events will undoubtedly influence market sentiments and could alter the course of gold prices. Despite the optimism, not all analysts are convinced that gold's upward trajectory will persist, even as the week closes with significant momentum. Nikki Shields, the head of metals strategy at MKS PAMP, posits that gold's recent surge could be attributed to a prolonged period of consolidation. She asserts that momentum may drive gold prices higher, but the fundamental economic picture remains unchanged. Peter Schiff emphasizes the recent rise in the Personal Consumption Expenditures Index, which was expected to remain stable at 2.8%, but unexpectedly rose to 3%. He views this as indicating increasing inflation rather than following the anticipated decline to 2%. This suggests a potential uptick in inflation rates, further supporting the case for higher gold prices. Let's delve into key moments from Peter Schiff's interview with these video clips.
We got the GDP numbers. This number came out on Wednesday. This is the Q4 preliminary number, and very close to consensus. They were looking for 3.3, and we got 3.2. A problem, and the gold market got hit a bit this day, the gold stocks, but more so because probably raising money for the Bitcoin ETFs. But the Personal Consumption Expenditure Index, which is what the Fed pays a lot of attention to for inflation, that was supposed to come in at 2.8, which would have matched the prior quarter's 2.8. Instead, it went up. It came in at 3%. We're supposed to be on a glide path down to 2. Well, obviously, we're not gliding down to 2. If we went up, we gained altitude, and we moved to 3. And in fact, we're going above 3. Maybe the next quarter, or maybe they'll revise this one. So this shows that inflation is headed back up. And this should be a much bigger problem for the markets than it was. But the fact that we didn't really get a big sell-off in gold, gold is starting to hold up better now with hotter than expected inflation. Now, eventually, gold's going to go up and up big with worse than expected inflation. When the markets figure out that worse than expected inflation isn't bad for gold because it means the Fed is going to fight harder to beat inflation, it's good for gold because it means the Fed has already lost and is giving up the fight. Inflation won, and it's going to move higher and higher and higher. I think what the markets did like is that the inflation numbers that are in here, the PCE numbers, came out in line. They weren't worse than expected. Now, they weren't better than expected, but they weren't worse. They were looking for an increase in the PCE for the month of 0.3, and they got 0.3. Year over year, they were looking for up 2.4, and they got up to 2.4. And on the core, they were looking for up 0.4, and they got up 0.4. And year-over-year core, they were looking for up 2.8, and they got up 2.8. So the market celebrated. In fact, gold was down a few dollars. As soon as this number came out, it spiked up about $12, $13 right away. So it was like, relief that inflation wasn't worse than we thought. Again, this is the wrong reaction. To the extent that inflation wasn't as bad as people thought, that's actually bad for gold. It's the other way around. But again, the markets are still not trading on that reality. They're just trading the way these algorithms have been programmed to react to data points. So they saw that the inflation number was in line, it wasn't hotter, and then there was a rally. And of course, the gold stocks, rallied strong because the number comes out an hour before the market. So gold reacts because gold's trading. And then the stock market opens an hour later, and we had a big move up in gold stocks.
Peter Schiff observes a noteworthy trend among investors, many of whom have been divesting their gold stocks in favor of investing in Bitcoin ETFs. However, he suggests that this tide could turn if gold prices ascend again. According to Andre Dragos, the head of research at ETC Group, there is a growing divergence in global fund flows, with increasing investment in Bitcoin compared to gold. Dragos believes this could be an early indication that Bitcoin could supplant gold as the primary store of value. ETF.com data from January 11th to February 14th reveals a considerable outflow from gold ETFs. Approximately $2.6 billion was withdrawn from the Spider Gold shares, which had assets under management of $58 billion at the start of 2024. Similarly, the iShares Gold Trust, which had $26 billion in AUM at the beginning of the year, saw approximately $507 million in outflows. These figures indicate a notable shift in investment sentiment away from gold ETFs. Let's get back to the interview.
A lot of liquidity came out of these gold stocks. That's a big problem for Bitcoin going forward, because what it really means is if gold takes off, and to me it looks like liftoff is close, and all of a sudden the people who got out of these gold stocks want to get back in, where are they going to get the money? Well, they got to take it out of the Bitcoin ETFs. See, it's not like a lot of people sold their gold and bought Bitcoin, because gold didn't go down. What went down were the gold mining stocks. And that makes sense that a lot of people have brokerage accounts, and in those brokerage accounts, they don't own gold, they own gold mining stock. Maybe they own physical gold outside of their brokerage accounts, but they bought gold stocks in their brokerage accounts to have a leverage play on gold. And it hasn't been working out. They saw these Bitcoin ETFs going up, and they said, hey, let me get in on it. Well, if all of a sudden gold takes off, remember, I mentioned the downgrade of Newmont Mining, or the fact that they had bad earnings. I forget, it got downgraded. Yeah, I think it got downgraded on Monday or Tuesday. There was a firm, I forget the name, they downgraded the stock from a buy to a hold. And a hold is Wall Street for sell, basically. They watched the price of Newmont drop like 40%, more than that from its high, a buy rating the whole way down. And then all of a sudden, near the lows, they say, well, sell or hold it. I mean, what kind of advice is that? I mean, I bought more Newmont myself on the day of that downgrade, and then it went lower, and I bought more, and I bought more again. So I bought a bunch of Newmont personally during the week. I mean, I love to buy downgrades, and I like to buy gold stocks when they're making 52-week lows, right? I'm getting the deal. And especially when I connected the dots, because I think the real reason for these big drops in Newmont is it's the biggest, most liquid name. That's the source of funds. Because as Newmont was getting killed, the Bitcoin ETFs were popping. They were going up 5-10% a day. And so that's where the money is coming from. And I'm thinking this is a gift horse. This is a great opportunity. The people who are selling their gold stocks to buy these Bitcoin ETFs, they're giving me a gift. They're making a huge mistake. The other problem is going to be when these guys who really, were in gold stocks and they just lost confidence. The firm that downgraded, and I forget the name, it wasn't a big name that you would know. When they downgraded it, they said, we're downgrading Newmont because we don't think there's much upside in the price of gold. I mean, we don't think it's going to go down, but we don't really think it's going to go up. And so we don't really have a reason to buy Newmont. They said in the downgrade that if their outlook changes, if the price of gold goes up and it looks like it's going to keep rising, well, then they'll upgrade the stock back to a buy. Well, the problem is, by the time that's the case, the price will be much higher. And so the people who sold it are going to be buying it back at a much, much higher price than they got out. But the problem is going to be if you sold your gold stocks and you bought any one of these Bitcoin ETFs, and then we get a big move in the price of gold, maybe it jumps $50 or $100, gold stocks jump 10 or 20%, and all of a sudden, people want in on these stocks. Aha, see, gold is now moving. I want to buy these gold stocks. Let me just take some money out of my Bitcoin ETFs. It's not going to work that way.
Analysts from JP Morgan recently expressed their belief that a series of factors, including expectations of a U.S. rate cut and a weakening U.S. dollar, will propel gold prices even higher. According to Gregory Shearer, the bank's head of base and precious metals strategy, JP Morgan firmly believes that gold will experience a bullish medium-term forecast, distinguishing it as the metal with the highest growth potential. What potential impact could an upcoming U.S. rate cut have on the gold market? And how might this influence investor sentiment? Share your thoughts in the comments section. If you liked the video, please subscribe to our channel. And remember to activate notifications by hitting the bell icon. Your participation means a lot to us. Thank you.